Now let's take a look at the bigger picture. Jay Hatfield's with us, Chief Investment Officer, Infrastructure Capital Management. Thanks for being here. So, the question is, what happens here? Will we have a hawkish pause, and do you see a soft landing?
Thanks for having me on, Nicole. So that's one reason the market's pausing, kind of obviously, is we have the Fed next week, and we also have CPI and PPI. And if you really look at the Fed, the voting members are 7 doves and 4 hawks. The most hawkish members are non-voting regional bank heads, 5 out of 6 hawks. So the math does favor a hawkish pause, but more importantly, the Fed really signaled this both through Jefferson's speech and the Wall Street Journal. So they would have to reverse that. So unless they call the Wall Street Journal at the last minute, one would expect them to do a hawkish pause.
Yeah, so a hawkish pause, as you said, the voting members, you described that, likely maybe we'll see a dove moment. Hawkish pause, I think, is the better way to say it. And then in July, what happens?
Well, that's where we're hopeful. Unfortunately, this Fed is fundamentally flawed in that they look at deeply lagging indicators. And the key indicators of inflation are the money supply and commodities, both of which have plummeted. And then the real-time indicators are PPI, and then we have an index CPI-R. Those both would have signaled for the Fed to raise rates a year before they actually did. And now they're both signaling a rapid deflation. So PPI and CPI-R, before we get the July meeting, will print, and most likely the year over year will be less than 1%. So we're hopeful, and it probably just is a hope, that the Fed will start to look at these coincident indicators. They're not just leading, they're real-time indicators, and then back off its rate increases, because we do have pressure in the banking system that's caused by the Fed policy. And in fact, the Fed itself is insolvent. So we think it's imprudent to raise rates now. So we're hoping the meetings later in July that they're always the last to know, but they'll figure out that inflation is rapidly declining.
And take that pause and make it a pause for real. Not just a hawkish pause for June, but make it one for real and say this is the end of this hiking cycle and we will now take a break. Doesn't necessarily mean a pivot, but it just means we will not be hiking anytime soon. What's interesting about what we're hearing, and anecdotally what we're seeing, and to your point, right, inflation likely coming down, but also the Business Roundtable's CEO index for economy. I mean, overall, the index is down. Plans for hiring are down. Expectations for sales are going down. So the big picture here is that, you're not seeing a ton of optimism or economic growth going forward.
Right. We're projecting just 1% to 2% growth. But the reason that we've been saying for a year and been correct that we're not going to have a recession is you really need to look at not just housing, which we've discussed before, but also all of construction. It's very healthy, 7.9 million jobs. That was the area that collapsed in 07-08. We've lost 2.7 million jobs in construction. And it's also being supported by the infrastructure bill and also the IRA that provides a lot of subsidies for renewables. So that's why we don't think we're out of a recession. That's why we're sticking to our 4,500 target. In fact, we really are talking about 4,500 being more of a floor than a ceiling on the S&P. So because we think we have decelerating inflation, but yet, surprisingly, a resilient economy.
Right, understood. So I want to hear more about this $4,500 level target for the S&P 500. When we talk about the different sectors, AI and semis have been really exciting. Where do you see growth going forward?
Well, so the way we get to the target is we do assume rates drop. So the 19 multiple is only really appropriate if rates drop closer to 3% from the 375. So it's a 19 times 240 on earnings, but surprisingly, and it's positive, earnings estimates for 24 have held up really well. In fact, they were up $1 or $2. So they're actually at 242 right now. So that's the math of how we get there. The reason we think we'll exceed that is it's normal for super positive developments in tech to lead to overvaluation, because that drives private investment, which then the time to market is shrunk. That's why the U.S. always beats the rest of the world. So we have a very vibrant capital market. We get overvaluation. So we think that the stocks that we traffic in, or dividend stocks, preferred stocks, REITs, those will rally because they're super cheap right now. And then the tech stocks we think are reasonably valued, but will become overvalued. And that's why we think it's more likely we exceed the 4,500 target.
I see. And then where does the crude oil prices fit in there? I mean, we are seeing that the U.S. is likely to raise its output. Meantime, Saudi Arabia is doing some cutting. Where do you see this all going?
Well, we're a little bit more pessimistic about U.S. production growth because commodity prices are down and the companies continue to be conservative. So we're lower than consensus on production growth in the U.S. But OPEC's very supportive. The real issue has been demand, particularly from China, a little bit tepid in the U.S. We do think that there'll be better travel as we get more into the summer, and the demand picture will improve. And also the dollar was strong for a while, so you always have to think about the dollar. So we're sticking to our 75 to 95 target. So that implies that we would appreciate off this relatively low base.
Yeah, I mean, tell me more about the dollar and where that fits in, because we've seen the dollar at 103, 104, hovering around those levels. Where do you think that stands? I mean, it's off its highs, but still.
It's at 90% driven by Fed policy, so it's strengthened. You know, we kind of had this big cycle in Fed expectations, partly because they're erratic. But so for a while, everybody thought, oh, they're not going to raise rates, and then everybody decided they were going to raise rates, and then the Jefferson speech, they decided they weren't going to raise rates.
Right.
So the dollar appreciated rapidly, which hit oil, and then it's come off at those highs. So we just have to watch that. It's really driven by Fed policy. So that would imply that the dollar would weaken, though, if we're correct, that they'll pause even in July as our economic, inflation data continues to improve, particularly the real-time indicators like PPI, CPI-R.
All right, Jay Hatfield, thank you so much. Infrastructure Capital Management. Thank you.
Thanks.